thank you everybody for joining us today. Really excited to get to today's webinar. Please do keep in mind that the content of the webinar is meant for educational purposes. This isn't investment advice. YCharts is not acting as a investment advisor in any way, and past performance is not indicative of future results, of course. Also, there will be a recording of this webinar shared out to you if you registered, so please keep an eye out for that. And you can always catch replays on our YouTube channel. So remember to like and subscribe to the YouTube channel so you don't miss any of our newly released videos or any content like this. We'd love to take questions during the webinar today. So the best way to do that is to use the Q&A feature there in Zoom. If you type some questions there, we'll try to answer those as we go. We'll certainly try to save some time at the end to tackle those. And if there's any that we don't get to, we'll try to follow up with you offline after as well. So look forward to that. And then if you like webinars like this is your first one or you're looking to attend more, we do have another one next week too. So feel free to register for that. I think someone on our team might actually throw the registration link in the chat. We've got Michael Kitsy's on next week to talk through a few other topics. But getting into what we've got today. So let's see here. All right. So I'm Caleb, Chief Product Officer here at YCharts. Done a lot of these, so maybe a familiar face. But joining me today is Michael Antonelli. And we're super excited to have you, Michael. Thank you for joining us. If you're not familiar with Michael, you probably should be. You might know him from his Twitter handle, Bull and Baird, and his blog, and all of the great content that he shares. But Michael, your day job, right, is that you're a managing director at Baird, and you do things like this for a living, right? You're very well known for breaking down great, I guess, sophisticated content, making it really easy to understand and kind of fun to listen to.
Caleb, I found a secret in my career, and this is going to sound crazy that I'm sharing it with everybody because, you know, this is like what I'm building my career on. Here's the secret, especially on Wall Street in general. If you talk in like an easy to understand way, it's actually career alpha. I know that sounds crazy, everybody, but if you try to take complex topics and make them easy to understand, especially in the wealth management space, it's career alpha in a major, major way. So yeah, I spend a lot of my days just producing content to send to our advisors inside of Baird and for them to send to their clients. And I enjoy it. We have a great team inside of Baird that produces content. We have an investment strategy arm named Strategist who also produces content. So our advisors have just a host of things to choose from when they're engaging with their clients.
That's so refreshing to hear too, Michael, because I think for a long time, the strategy has been talk in terms that nobody can understand. So you kind of create this barrier to entry, but your approach is great. Looking forward to spending some time talking to you today. We're going to go through several things. So YCharts released maybe a few weeks ago, kind of a slide deck with a lot of visuals. Kind of the idea there was to create some kind of evergreen talking points that advisors can use when talking to their clients, and really to do three things. One, to help them be confident to stay invested. Two, to help them to keep investing through all different types of market conditions. And three, to manage their expectations, whether that be in up markets or down markets, and kind of help keep them level-headed. So we're going to mix some of those visuals in, but more specifically, we're going to go through a few things, right? We're going to talk about what's been happening in the markets this year, and maybe get your take on how to explain those things. We'll talk about that power of staying invested and why that's usually a pretty good strategy. We'll talk about how to answer some common client questions and put some cool visuals and data into those answers, which might make your point more compelling. And then I'm going to turn things over to you to run with your own kind of take on decoding the psychology behind an investor and how they might be thinking about things in the market. Looking forward to that.
Yeah, I mean, everybody stick around for that last section. I'm so excited for the last section because I think behavioral finance is the key to the future, the future of what we do. So
wouldn't miss it. All right. Well, let's jump in. So we're going to start by talking about what's been happening in the market this year. So our first visual here is the Quilt chart. And when you look at this Quilt chart, you can see the different performance of asset classes over the last 10 plus years here, as well as the last several quarters. How do you use a Quilt chart? What do you talk about? What's the story that you tell here, Michael?
So Quilt chart's the ultimate, here's the menu for clients, right? Here's the ultimate, these are all your choices. These are what we're going to build into your plan. This is how they've done over time. And I think one of the things that's really, really important to remember about an asset Quilt chart, or when you're engaging with clients at all about what's in their plan, what's in their portfolio, is that my friend Brian Portnoy said this best. Diversification means always having to say you're sorry. I'm giving him credit for that. I think he did say that. But
we had him on. We had him on a
Yeah.
couple months ago, and he said that's the quote that he most recently does not get cited for. So he'll be.
Yeah, I'm citing him. I'm citing him. But look at the quilt. You see negatives, you see positives. Look at 2022. You see just an absolute mess between treasuries and equities, and that was the biggest problem in the wealth management space last year. Is that bonds just kind of didn't do what they normally do, right? Which is kind of hedge your equity exposure, and that was a lot of pain. A lot of pain, not only. I'm sure for Baird clients, but for clients everywhere, because if you build a diversified plan, you expect them to act in a certain way. So when they all start moving together, especially bonds and stocks, it's really, really painful. But Caleb, I have a couple evidence-based insights. Can I throw those out here before we move on? So you'll notice 2022 a bad year, right? Just across the board. I think if my memory's correctly, the 7th worst year in history for the S&P 500, and the other ones are like the Great Depression and 08, and so really, really a bad year. The start of this quarter, right? The first quarter this year, you'll see that on the far left. You'll see Q1 for 2023. We were up more than 7% in the S&P 500, which is great, right? You see it up there in the upper left-hand corner. When the first quarter, the S&P 500 is up more than 7% in the first quarter. That's happened 16 times in history, okay? 16. It's not a lot, but 16 times in history. The full year has gone on to be positive every single time. And here's where I insert my version of this. Past performance is no guarantee of future results, right? This is just the evidence of history. This is not me saying this happened. This is just what has happened. And then I got one more for you. When the previous year has been negative, like it was in 2022, and the first quarter is positive, like it was this year, April and the rest of the year has been positive 10 out of 10 times. There's a few less of those, 10 out of 10 times. And I say those not because I think that they're super valuable. They're interesting talking points. Why does that happen? Well, I mean, bad times get worse. That's what bear markets are about, but good times start to get better. And when you see the first quarter positive, maybe good times are starting to get better. And that's one of the reasons why those evidence-based insights occur. But yeah, I think the main takeaway, Caleb, especially if you're going to show this to clients, is that not everything's going to be positive at the same time. You have to learn to live with that.
Yeah. And, it's good to have some positive talking points too. I think there's been so much negative commentary around the economy and the markets. So having some of those evidence-based talking points, even if it's not a guarantee of what's to come, good to mix in there. But looking closer at that first quarter, you mentioned the S&P 500 was up 7.5%. We had a huge spread between the NASDAQ and the Dow and some of the other major indices. We're kind of all over the place. How do you explain that big gap? Yeah,
look at the NASDAQ composite, right? Probably driven by a lot of moves in Meta and Amazon. And so remember last year, we absolutely shredded the FANG stocks. They got destroyed. And there's a couple charts we have later that'll kind of show that in a little bit better perspective. They got destroyed. I mean, large cap growth was just taken out to the woodshed and just absolutely punished. So to see this start of this year, I think the more important thing is not explaining why the NASDAQ's doing better than the S&P, is why are we up at all? Like, why is it up this much at all? Because 7% is a lot for the first quarter. It's a lot. And I think the primary reason is everybody came into this year expecting a recession right away. We expected a recession right away. We're talking about, I remember big research shops saying, we expect payroll growth to be 50,000 in February. It was 300, right? We've added 1 million jobs this year, and the housing market hasn't fallen apart. I actually said on Twitter, and I said on a video recently that I did, that are things actually fine right now? Are they fine? Right? Inflation's falling, the 10-year's at 3.4, the stock market's up. Are things actually just okay? Doesn't mean they're amazing. Doesn't mean they can't get worse. But are they just fine right now? I think they are. So I think we're a little over our skis on the doom and gloom. Again, this could happen. Like if a month from now, this looks like the worst take in the world, it could happen, right? Anything could happen. The bear market of 2000 got worse by a terrorist attack in 01. So things can obviously get worse. But I think these returns you're seeing on the screen are because things weren't as bad as people expected.
And when you look at these, right, you mentioned, obviously the NASDAQ having huge returns. We see the Dow down there at like 1%. If we look at sectors, maybe it's a little bit more telling us to, there's a lot of good news in the market, but maybe also some bad news. Anything that is particularly noteworthy worth talking about here? I mean, there's a lot of undertones here with financials and, technology and some of the large caps that we talked about, but what else is being explained by the sector performance? So
there's a standout here that I want to point out. There's a standout. So one of my favorite charts, and it's kind of driven by my friends at Strategist, is they take an equal weight consumer discretionary and they divide it by an equal weight staples. Why do they equal weight it? Well, they equal weight it because you want to take out the effects of Amazon and Tesla, the big ones, right? Look at the consumer discretionary here, which I believe is the purple, right? So plus 13, look at the consumer staples, the green, that's plus 1. Divide those, equal weight those and divide those. what does that mean? Well, that means that risk on, right? People are buying discretionary stocks. They're getting rid of staple stocks, or discretionary is going higher than the staples are. It's a really good chart. You can make it in YCharts. I made it in YCharts. It's one of my one of my templates that I saved because I look at it all the time. It's just a really good risk on, risk off indicator. So I wanted to point that out here, that's how much better discretionary is doing than staples, which is a really good signal. But you see comm services technology, that's a function of just how much we crushed those stocks and how much they bounced in the first quarter. I don't think that's necessarily telling that, though we need to rush back into those stocks in that sector. I have the belief that the sectors that led the previous decade aren't going to lead the next decade. So I'm not really keen on rushing back to these, but I think this is a function of just how badly we killed them last year.
Yeah. Looking at, some of the charts that we had in, Q3, early Q4 last year, we were looking at some of what actually had been performing well, right? Things like commodities, utility, energy, and talked about how, hey, these are late economic cycle sectors that perform well. That's shifted, right? Now we're seeing some things that, growth stocks, technology, consumer discretionaries, like you mentioned. Is that an indication of a shift as to where we're at in the economic cycle?
I think it just is back to this notion of risk on, risk off. I think people in the first quarter have changed their minds about how bad things are going to be. And if you see, Meta down at 90, or you see, I don't know, Facebook, Amazon, any of these stocks, you see them getting really crushed, you might say, where can I get the most kind of bang for my buck? Not that I'm saying to buy those stocks. I'm saying that's generally, I think, what the reason was that they moved so much. One thing that does bother me here is financials. Look at how bad financials are in the first quarter. And we'll talk about that in a second for the obvious reason. But I would feel better if financials were doing better. That's one thing that still bugs me about the market today.
Well, let's talk about that a little bit, because obviously the financials sector has really been impacted by some of the bank collapse and fears around financial institutions. I guess, first of all, how are you easing investor concerns around that? Is money safe? And then, anything else to add on that sector?
I mean, look at the bottom, everyone. Is there any theme you see down there in terms of industry or sector? I was on Bloomberg the other day and I was telling them about my views on the market, and I actually threw out this take, Caleb, and I actually believe this to be true. Was that actually a banking crisis? I don't actually think it was. I don't have a great term for it. Maybe turmoil, maybe skirmish. I don't know what the right term for it is, but there are such deep scars from 2008 that when the word bank comes up, when the word crisis comes up, when the word deposits come up, we have this kind of instantly horribly negative reaction back to what happened. And I actually wrote a blog called Anxiety where I wanted to address that. Hey, there's a level of trust that's built into every financial system. So it's a matter of, how do you deal with that trust waxing and waning? And yeah, we went out to our clients and addressed their money. We went out to the world and said, here's why why we believe that this is the place for you to do business at. And I think everybody essentially had to do that. And when a banking crisis or a banking skirmish or whatever you want to call it unfolds, it puts fear through the system, and human beings are prone to that. We'll talk about that at the end. But I don't, SVB and these were banks that were mismanaged. They didn't hedge their interest rate risk. They were kind of built for a ZIRP world. Does that affect a bank in Alpharetta, Georgia? Does that affect a bank in Oshkosh, Wisconsin? I don't know. At this point, it doesn't seem like it. And I think the policymakers move fast enough to actually stem that contagion.
That was my question, right? Because maybe it could have been a bigger crisis had, policymakers not moved quickly and kind of restored confidence. So you think that was the right move and thwarted?
Not only do I think it was the right move, we didn't inject taxpayer capital into the banks. I mean, back in 2008, we were all right, let's prop up the banks with equity and take their debt onto our balance sheets and all these things. We just said depositors, the government, the FDIC said depositors will be safe. They didn't say, executive bonuses at these banks will be safe. They didn't say we're saving the stock. So I think we did learn from 2008. I think that was one of the reasons why we moved on so quickly from it. But I think there's probably still a level of regulation that needs to be brought down from the political level about deposits. Right? I still think that probably needs to be codified.
And probably some caution that should be taken if somebody's taking the advice from the last slide and saying, hey, where's there some value? And I would be I think we're in a world that will always jump to the worst case scenario the minute something happens. It just, that is the version of the world we're in because everything's so noisy. And I think if you can keep your head, if you can do the average thing, even during the SVB thing, you're better than 99% of investors. You really are. You just have to do the average thing. All right, so our last chart for this section is looking at different factors, right? So we've got growth and value on here, and then we've also got large cap and small cap. Again, this huge spread. Anything that you didn't mention in regards to Meta and Apple and some of these big companies that are leading the way that is contributing here?
Yeah, and this is year to date, right? So yeah, January. So this is like quarter to date, year to date. Just one thing to notice. I mean, the darker shade of the two is the Russell 1000. So the bigger stocks, the lighter shade is the Russell 2000. So the smaller stocks. This makes sense to me, right? These are dominated by the big. Russell 1000 is dominated, by the big companies. And to me, I think it just reminds me that, at the end of 2022, people are like, oh, growth is dead. This factor is dead. It was good for a decade. It's dead. And it's so hard to make those kind of statements, even if you believe it to be true, even if history says it's true, even if all the metrics are first decile and all those fancy terms, like, look what happened. The biggest stocks did the best in the first quarter in both the Russell growth and the Russell value. So just be cautious about factor investing. Factor investing it has the most history and analysis from it. I mean, I went to the University of Chicago, factor investing, I think it was born from there, but just try not to take too many factors and build your models off those, because they can go so long outside of history.
All right, well, let's jump into our next section. So now we've got, I guess some more evergreen charts, longer term trends that we'll look at in the market, and use these to kind of tell the story of staying invested, right? So our first chart here looks at a $100,000 investment made in 1990 through the end of last year, and explains the annualized returns in some different asset classes. So how would you talk to this chart? What are the big stories here?
Multiple thoughts. I mean, certainly something I would show to a client. I think this is something I would show to a wealth management client, just to remind them that long term is the power, where the real power and real compounding takes place. I'll get a little math nerdy here, Caleb. Maybe there were some math nerds on here that really want to jump into this. Like, the compounding formula, has time in the exponent. That's fancy nerdy. I'm sorry, guys, but the compounding formula has time in the exponent, which means that's the most important factor in that formula. And I think this chart really shows well. One thing I do want to address, and while I would talk to clients probably a little bit about compounding and these numbers, this kind of stuff can get a little bit lost on people, okay? There's a behavioral reason why, okay? That long term that you're seeing there, great, right? We turned 100,000 turns into what, 2.1 million?
Yeah, a little
bit. Past performance, no guarantee future results. I'm saying it again. That long term, my friends, and this is a great way to talk to clients, that long term is made up of a bunch of short terms. Okay, a bunch of short terms make up that. And you have to get your clients through the short terms. The long term sounds great, but people don't think about their lives 30 years from now. They think about tomorrow, and then they think about the next day. So you have to combine this with a crazy term, which is think short term. Should you think short term? You should, to get through the worries. Okay, and then also look at this chart. See these gray bars? There's 4 recessions on here. 4 over this time frame. I believe this time frame is about 32 years, roughly. 4 recessions. What's also in here? 4 bear markets. So when I go out and talk to clients, I say, these are going to happen. Okay, they're going to happen. They've happened all of our lives. They've happened all of your lives. They're going to happen to all our children's lives. I don't want you to have a forecast about these happening. I want you to have expectations about these happening, because to me, expectations are more important than forecasts. They're much more important. Dear Mr. or Mrs. Client, we're going to have 1 recession every decade. It's going to happen. I'm going to plan you through that. I'm going to build your plan to get you through that, knowing it will happen. Dear Mr. or Mrs. Client, there's going to be 1 to 2 bear markets every single decade. I'm going to build a plan to get you through that. I'm taking those into account. So while I love this chart, and I'm probably talking way too long on it, just remember this is made up of a bunch of short terms, and that's where people live.
So I think we'll get into that too. I guess the next one here tells the story of what happens if you stumble at those points, right? So you get to that first bear market, second bear market, third bear market, and you say, you know what, I can't take it. Let's move to cash. So we've got 3 scenarios on this chart. That purple line is if you don't do that. And it's what happened from, to that investment from 2003, to 2023 very recently. The second one says, we moved to cash, and then a year later, we got you back in the market. The last one says we moved to cash and we kept waiting. And we said, we're going to wait for that right opportunity to get back in the market. And it never came, and you stayed at cash. So I guess, how do you talked about the fact that you have to get through these bear markets. Yeah. Does something like this help you convince clients to stay invested?
It does at the margin, but I think that being a storyteller is better than, you know, trying to say, hey, timing the market doesn't work. Here's a dozen reasons why. Is because their brains are all fired up. Their brains are all thinking about the worst case scenario. And look, you're out for just 1 year here. Look at what you do to your return, right? You absolutely devastated. If you leave the market completely, it's just, you know, it's almost tragic. And I've heard plenty of stories of people that did and never got back in. There's the chart at the end that we'll have about how hard that is and what people face about that in our BFI section. But no, this Nick Majuli, another friend of ours, right? Nick Majuli, a really good a really good author and kind of strategist. Like, he talks about the fact that even God couldn't beat dollar cost averaging. He just, like, you couldn't, right? Because if you said to yourself, I'm going to be in cash only when the market's cheap, you'd be out of the market for like vast stretches. I'm only going to be in the market when CAPE is below this level. You'd be out of the market sometimes for like 5, 8, 10 years. And you can't recover against somebody who's just literally chipping away DCA. So I like this one and the next chart because the what makes all of this so hard. This one, which is like kind of missing the best and then also missing the worst. I'm glad you guys added missing the worst.
Yeah, so this is funny. We actually, you know, we first published this where we just showed missing the best and how much that would be detrimental to your overall returns. And we had a number of people say, hey, well, what if you miss the best?
Or miss the worst.
I said it the wrong way, but you know what I mean.
Yeah.
You know, what if we can time it up so you miss the worst? Like, what kind of upside does that provide? I think the question is here is it worth the trade-off, the risk of missing the best?
I mean, look at them missing the 50 worst days. The return is absolutely absurd. And frankly, you know, that purple line is probably the reason why, you know, a lot of people enter the active management industry, right? Because you want to try to obtain that purple line. It's just so hard. And again, like you said, like a lot of people go out with like, hey, you missed the 10, you missed the best days, and which is this chart on the right. Look what it does to your return. Even missing the 10 best days, you almost cut your return in half. And you know, the other argument, which is if you miss the worst, look what happens. It's all just a moot point. These things literally exist side by side. If you were to list the 10 best and 10 worst days, they almost exist side by side. A lot of them are in 08. A lot of them are in 2020. There was a day in 2020 where the Dow was down 10%. Does anybody remember that? It was like an outright disaster. I was sitting in my basement thinking like, should I be buying like canned goods? Like, what's happening here? Like, the stock market's down 10% in a day. Then the next day it's up 8%. Like you're never going to be able to capture that. There's no way. It's just not possible. So I think showing this is good. But I think it's better married with a story, or better married with the take that these exist side by side. You'd have to be able to almost day trade the worst and best days. And it's just, I've dealt with institutions, I've dealt with retail investors, I've dealt with all sorts of kinds of investors, and it's just not possible.
Yeah. And I think that, you know, the chart before kind of proves that point too, where if you moved to cash for a year, you probably missed a handful of those best days.
Yeah.
I think the next one tells a great story though, right? You know, if you get back to explaining that past performance is not indicative of future results, but how confident can you be? How confident can you be if you're going to stay invested that you're going to see positive returns?
This is everybody listening, everybody who watches this later, Caleb, all my friends at YCharts, all my friends all over the world on Twitter, whatever. This is my favorite chart. Like, this is like, I generally don't bring many charts to client meetings because I just want to hear their stories and help them understand a plan and what that will do for them. This is the one of like two that I would bring. We have the other one later. And let me tell you why. Morgan Housel said, I keep dropping names here. Morgan Housel said, he said, every discussion about the stock market is just people with different timeframes arguing over each other. And that's 100% correct. Like if I'm a sovereign wealth fund, okay, and I'm managing the wealth of a nation, what's my time frame? Technically, it's infinite, right? I want my nation to be around forever. Technically, it's infinite. Say I'm a day trader, what's my time frame? The next 24 hours. If say I'm an institutional investor, what's my time frame? Maybe you're quarterly. You know, you're owning the stock for quarterly. You want to try to maybe semi-annually, whatever. Everybody has different time frames. This chart shows you what are the odds the stock market's positive over any given time frame. And do you guys know what it is for one day? Like so 1 month is where we start here, but for one day, it's about 51-49. So 51 positive, 49 negative. So it's essentially a coin flip. It's slightly positive because momentum is a factor, but it's basically a coin flip. Out to 1 year, it's about 74%. So if you had a client come to you and say, hey, I have this money I just inherited. I want to invest it for a year while I think about what I'm doing. A great way to address that would be, hey, based on the history of the stock market, you got about 26% chance to lose money on that, 74 to make money. And do you want to take those odds? But the longer you go, the more the odds move in your favor. And ultimately, this is a game of probabilities, my friends. How can we get the odds of success the most in our favor? And that is going down that chart.
And this one, I guess, maybe just takes that same message and speaks a little bit more to the math nerds, but you can see the volatility associated with some of those shorter periods. So we don't have the 1 day in here, but we do have the 3 months down there at the bottom. And you can see, over the long-term average, that 3-month return is still going to be positive, but you can see there's a lot of volatility there. And as you get longer and longer.
I made one of these on YCharts with like the range of outcomes, like 1 year, 5 year, 10 year for stocks, 50-50, because it's a big, kind of a wealth management portfolio, and then all bonds. And the range for stocks, my friends, in 1 year is like minus 47% to plus 60%. Like 1 year. Like that range is just massive. So if you go to a client and say you want to invest for 1 year, hey, Mr. or Mrs. Client, Mr. Family, whatever, your range of outcomes is minus 47 to 60. But if you go out, the range really starts to narrow as you go down. You'll see that on this chart. You go up to 20 and, it starts to be in their favor. And I think that's the most compelling way to talk to somebody about investing is, what is the purpose of your money? Why are you doing this? What is it for? What is your goal? What is the purpose? How long do you want to invest it for? I think those are the fundamental questions. And some of these charts are really good at helping guide that conversation.
So our next section maybe gets into some of those questions. And our first chart here, it might be a little tough to see on the screen. Again, this is something that you can get from YCharts, but it kind of answers that question that maybe clients ask, which is, I heard some bad news. Should we sell? Should we move to cash? And it seems like there's always a reason for that, right?
Here it is. Here's number 2, my friends. Here's the second one that I would bring to a client meeting. The first one is the probability of success. The second one is this. I adore this chart. Michael Batnick makes a version of this that I absolutely badger him on DMs about updating. He says he doesn't want to, but I'm going to make him. This is a great one. I'm glad YCharts has one of these. I requested a template of this. People are really, really prone to living in the now. They just are, right? That's who we are as a species. We live in the now for millions of years, or not millions, like tens of thousands of years. Human beings have lived in an immediate gratification world. If I'm hungry, I eat. If I'm cold, I get warm. Like we live in the now. And when we tell somebody to live in the future, it breaks their brains, right? Hey, save for the next 20 years. And what they do is they say, now is the worst as I've ever seen it. This is as bad as I've ever seen it. Politics, the media, news is as bad as I've ever seen it. Then you bring this chart to them, you say, gosh, I bet it was really tough to live through the Korean War, and then the Cuban Missile Crisis, and then the energy crisis, and then that inflation crisis. Like, I bet it was really tough to live through those, and they'll shake their head. And you start to bring perspective to them. And this chart is really, really good at doing that, because this chart will exist the rest of our lives, and the rest of our kids' lives, and the rest of our kids' lives. I think if you're going to use this, you need to relay this message to clients. Here's the message. This is gold, my friends. That the world's going to break all the time. That it's going to break. In fact, you can assume that the world will fully break once a decade. But I'm here to help you through when it fully breaks. That's what we will do at Baird. That's what we tell them. The world's going to break every decade. We were going to get you through those, because we're building you something that understands it will break every decade.
All right, moving on to the next question that we might face, right? So, and I think this is something that you and Nick Majuli have also done a fair amount of work on and thought through. And you quoted him earlier. You said, even God couldn't beat dollar cost averaging.
Yep.
But what can be dollar cost averaging is just investing all of your money right now, right? So you have a client who has a windfall, who has a large sum of money. How do you convince them to take the plunge, or for the analogy of jump versus wade, into the water?
I love that you guys have this on the surface, because this is something that you have to look at the data to really comprehend, because you would think, gosh, there's no way that I'm going to put all my money in. There's no way that beats buying slowly over time. It actually does. The math is 100% proven. But Caleb, here's my take. This is not actually a math question. Whether your client should dollar cost average or lump sum is not a math question, because the math is solved. This is actually a behavioral finance question. And I'm glad we're leading into that next section. This is a behavioral finance question, because as you guys will see on this chart, lump sum does beat dollar cost averaging. Because why? Because the stock market goes up over time, right? It slowly grinds higher over time, which means the longer you wait, the higher the more you're paying up. Switch to the next one, Caleb, just really quickly. But actually, dollar cost averaging does beat lump sum sometimes. You know when? It beats it when the market's getting destroyed. So you'll see over here on the left that in 2022, the dollar cost averaging beat lump sum investing. So I just said this isn't a math problem. It's not a math problem. This is a behavioral finance problem. It only beats it when the market's getting destroyed. How hard is it going to be to convince your client to keep dollar cost averaging when the market's getting destroyed? It's really hard. Hey, Mr. Mrs. Client, we should keep up with our once a month investment. Yeah, but I just saw the stock market's down 22% year to date, right? You're up against their behavior. You're up against emotions. And they're just normal. They're just like me and you. They have emotions. We have emotions. So I think the answer to this ultimately, and this is what I've landed on as a take, is buy something right away and then dollar cost average. Because I think that's the answer. This is just my take. I don't have math to prove this. I think this is more of a behavioral answer, which is, hey, I got you something going. If it goes higher, hey, I'm glad we bought some. We're gonna keep dollar cost average. If it goes lower, hey, we have a bunch of powder dry that we can keep improving. I think that's the answer. I'd love to hear what people say about that. I'd love to, maybe the chat has a view on that, but I think that's ultimately the answer. And a lot of smart investors and advisors inside of Baird, I think we talk about this a lot. And I think that ultimately this is a behavioral finance question because people hate losses right away. They hate them.
Yeah. Especially that big loss, right?
Yeah.
You see a big decline in a statement quick. That's hard to overcome. But yeah, like you said, if you can take that and you can flip the conversation and say, hey, now we have an opportunity to buy more and lower your cost basis. But either way, I guess there's some good charts and compelling ways to
yeah.
And then the last question that we're going to talk about is, that question of how much can I draw on my portfolio, and can I draw more? Or am I drawing too much? How do you think about, talking through that, income stream and how, somebody might need to preserve that portfolio?
These are great. Again, there's so many things that I love that I could just kind of spin up on my screen at work and I can look at and I can test my hypothesis, right? Hey, what would this have done to a client's portfolio? Let me just look at, some sort of withdrawal rate change. So I like that. I don't know where the 4% came from. I think there's actually an author that kind of landed on why 4%. But if you'll see in these charts, if you up it a little bit, like 4 versus 5, the purple line, 4 versus 6, you actually deplete the portfolio. 4 versus 8, it depletes way earlier. I think these are good, but I would probably lean into using this in my background and then trying to tell the story of, hey, Mr. and Mrs. Client, we want to preserve your money, not only for you, but for a legacy, right? You want to leave a legacy to the world, whether that's family or a nonprofit or helping a college or something. So as we think about our withdrawal rates, we also need to think about that legacy at the end. And, it's tough because you're trying to predict what the future would look like in terms of their cash flow and what the market might do. I like looking at historical analogs. I also like looking at worst case scenarios. I don't want to give this away on here because I'm to try to use it from some of my own content, but Caleb, I looked at the worst 20-year period to be a retiree in history. The worst 20-year period in history, what it would, and take out 4% from a 50-50, $1 million, same thing. I actually adjusted for inflation. And I wanted to know how that couple ended at the end of the 20 years. Did they run out of money? And I plugged it into YCharts and it gave me the same answer. It's going to be a blog that I write. It's going to be a video that I do. You'd be surprised what this 20-year period is. Most people think it's the Great Depression, but it's not. But I will say, I do like this kind of thoughtful, hey, what would have happened if we plunked you into this point in history, especially the worst cases, because, it's hard to get worse than worst case. It's possible, but it's really, really hard.
Michael, you've told me about that analysis before. I didn't want to,
I put it on Twitter too, so maybe people will go find it on Twitter, and I'm just blew my entire blog, but.
A super fun thing to look at though, right? And you can run different scenarios in YCharts and see how somebody would fare in those situations. You can plug in different allocations and see how those would perform. But it's again, a nice visual to be able to tell that story, but I think that legacy piece is important. All right. Well, as promised, we saved time to go through your guide to client conversations, especially with a tilt towards behavioral finance. So I'm going to drive the slides here, but I'm going to let you do the talk track. So
awesome. Okay. So it's part of my job when I go out on the road or when I do webinars, when I speak to our clients, I not only, like to use images and stories. I mean, what I really like about YCharts is I could just put a simple chart of, hey, here's what stocks and bonds did, and it tells a great story. I lean on those things for storytelling more than anything. But this is my favorite part of talking to clients and talking to internally inside of Baird, and even to my family and friends. It's just, what is really driving your decision making? Why are you doing the kind of things you're doing? How can we help you overcome problems? How can we help address this kind of humanity that you're living with, which is neither right nor wrong? It's just who you are. And this, I just love this meme so much, because it's not only what you face as an investor, it's what you face as an advisor, it's what you face as a friend, as a spouse. Your mind is going to pump highly unlikely scenarios into your world constantly. Here's a prime example: the US dollar declining, or the US dollar going away. It's just happened over the past few weeks. And I've spent, I don't know, a dozen, 2 dozen calls talking through it, because their minds are driving highly unlikely scenarios into their brains. And this is normal. I'm not saying this is not normal. It's just a function of who we are as people. We tend to think of the worst case scenario. We don't tend to think that everything's going to be fine. So whether you use a chart, or whether you use a story, or whether you sit down with a client and just really talk them through a difficult period, just know that this is an evergreen meme. This is an evergreen meme. If you're an advisor or a strategist, or I kind of think of this 2 ways, Caleb. You think about, debunking national debt, or debunking the dollar, or debunking politics, and then a year later it just comes right back, right? So it's almost like you're Sisyphus, right? You're pushing the boulder up the hill, and then it just kind of slides back down on you. So you're either Sisyphus and you're doomed to do this, or it's kind of really good job security. That you think about it like, people are emotional, and you're going to help them overcome these problems. And that's the value of being able to address this stuff as an advisor, is like immense. And it is a huge, 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 huge component of being a good advisor, is getting people through difficult times that have been spun up by the media, or been spun up by a friend, or been spun up by something that they heard or read. And just remember that you're going to face this problem forever, and having real, tangible ways to address it will be important.
As a fairly new father, I can confirm that always expect the worst.
How about when your kid gets croup and they start coughing, and your wife's like, I think we need to go to the ER right now. Like, it's the same thing. All right, so I used this to end my event last year. It's Wait But Why, which is Tim Urban, who just wrote a new book. He's on Twitter. I used this to end my event last year, because we were going through such a difficult year. And I wanted to remind people that human beings in general, are very linear thinkers. We're very, very linear thinkers. What does that mean? It means that when things are going well, we think they're going to just go well forever. That's this kind of green line in the upper left quadrant. When things are going poorly, we think they're just going to keep going poorly forever. And we know that while human beings are very linear thinkers, it's a trampoline world. It's a trampoline world. So I focused them on the bottom part of this slide, on the bottom part of this image, where I said things are going really bad right now. And your mind might be telling you that they're going to keep going bad forever, and that you need to worry, and that the constant compounding of that highly unlikely scenarios, when we really know it's just part of the ups and downs, right? Think about your life. Think about your career. Think about your marriage, your relationship with a spouse. Think about everything in life. It's all about the ups and downs, right? It's all very cyclical. A career is very cyclical. The market's very cyclical. Being an investor is very cyclical. Being a good father or being a good spouse is all very cyclical. You're going to have your ups and downs. And then I would end with this, and we can move on. Like, nobody avoids failure, right? None of us avoid failure, whether it's an investor or a career or a family. Like, you're never going to be able to avoid failure. You're never going to be able to avoid the ups and downs. And if that's the case, if we can't avoid it, then what's the best way to address it? The best way to address it is to not let it overwhelm you. It's to learn to cope with obstacles as they're presented to you. So while you're in 2022, you help your clients cope with those obstacles, not let them get overwhelmed by them. And I think that's pure wealth management experience, the kind we build at Baird. Like, you're building that experience for them. So when times are tough, you can put into perspective that it's about the ups and downs, and help them through that moment.
Reminds me of those kind of zoom out views, right? Where you zoom on anything close enough, and then as you zoom out further and further, you get the bigger picture. So powerful to take that long-term view and show that. So this one I like, because
I think it's a good roadmap for not only a clients, but an advisor in the relationship with their clients. So you have to understand one of the biggest components of human well-being. Okay, there's about 4 components of human about the well-being of the average person, you, me, anybody, frankly. One of them is control. Control is a big component of humanity's well-being. And when you feel like you're losing control, it really affects you as a person. Your well-being takes a big hit. And that tends to happen by all these things you see on the screen, right? All the things that are in the gray, all the things that can affect a person that are out of their control. And it's a struggle. It's a struggle because if you're a successful business owner and you're transitioning to retirement, you've built a business, you're super successful. You've kind of laid the foundation of a very strong financial life. And then all of a sudden you turn the switch and you say, I'm going to retire and I'm going to enjoy the fruits of my labor and I'm going to experience this next phase of my life. All sorts of things start to swirl out inside of your head, markets, economy, Federal Reserve, all these things. And a good way is to try to redirect them inside of their heads. And of all of these, Caleb, of all of these you see inside the head, all these colored puzzle pieces, I think the blue one's the most important. We're going to end on that. I think the blue one's the most important because of the reason from the first slide we had with the tuba. Is that a tuba? I don't know. Is that a French horn? I have no idea.
I think it's a tuba.
Maybe it's a tuba. That blue component is what's really in their control and will help them immensely. I also think from an advisor perspective, that purple one is really important to think about. You can be an expert in taxes, and that's that's alpha. That's career alpha to be an expert in taxes. For better or for worse, people don't like paying taxes, right? It's just this thing. Nobody likes paying taxes, like none of us do. In the wealth management space, I think it's a really crucial thing. And we have some of the most talented tax strategists and specialists inside of Baird. It's an important component of engaging with a client, but portfolio, savings, behavior, expense fees, all those things are really important. And you just have to remember that you have to redirect them inside the brain and out and away from that kind of outside ring.
The taxes one is interesting because I bet if you gave somebody a list of all these things instead of put them inside or outside of that control circle, most people would say taxes. You hear that old saying that sticks in your head,
death and taxes. Yeah.
2 things that you always have to live with.
The landscape is changing so much. That's why it's good to have a partner, right? That can help you address that kind of changing tax landscape.
Yeah. I try to convince my wife sometimes that the behavior one is out of my control.
Yeah.
All right. I love this picture.
Yeah. So this is my friend Ashby. Everybody should follow Ashby on Twitter. He's MV Money Visuals. We've got a couple from him. We'll just address this one really quickly. I find this the most ironic slide in the history of irony. It drives me nuts. I don't get it. If you were to ask somebody like, would you have bought the dip in 2011? Would you have bought the dip in 2015? Would you have bought the dip in 2018? Would you have bought the dip in 2020? Almost all of them would say yes. But every single sell-off in the future is viewed as nothing but risk. It's the great irony of this industry of being an investor. This is where I try to tell people that, does anybody remember why the stock market was down 20% in 2011? Does anybody remember that? It was about 12 years ago. I would even ask the chat, does anybody remember 2011? We had a really bad stock market year. Felt really terrible. We were kind of post-crisis, but something else cropped up. Most people say, no, I don't remember. No, I have no idea. It was 11 years ago, Mike. I have no idea, right? It was the Greece, right? Yeah, great answer. It was the European debt crisis. Was that an opportunity for a long-term investor to invest in? I mean, his history would say that it was. What about the 2018 sell-off because the Fed was hiking? Was that an opportunity? History would say that it was. But the sell-off in 2022 is viewed as the absolute end of the stock market. Everybody's going to zero. Stocks are going to zero. This is at the root of behavioral finance, everybody. People think that since the future is unknowable, that it has to be risky, even though they have lived through 50 or 40-year life, 50-year life, 60-year life, 70-year life. They lived through all that, and they've been through all sorts of crazy scenarios. The future is nothing but risk. And I'll just end on this statement, and we'll go to the next one, which I love, which is, Caleb, everybody on this call, everybody in the world, everybody in this industry, everybody in the world, our collective knowledge is about the past. Our collective knowledge is about every single thing that just happened. Yet we live in an industry where you have to make decisions about an unknowable future, right? We have incredible knowledge about everything that just happened. And this is where, a really, really good advisor, a really, really good strategist can help people understand that the future is not this kind of gaping chasm that's going to suck in the world and just chew it up into zero. It's just going to be like the past, which is a crazy world, right? Remember, history is just one damn thing after another. That's it.
Well, we talked about how there's always a reason to sell, right?
Yeah.
And I guess, in that same vein, never a good time.
This is what 2022 is going to look like. This is what every bear market will look like. And this is something that people suffer from, right? They say the market's where I'm not going to buy. Then it gets crushed and they're like, oh, I'm not buying. It's going to go lower. Then it bounces and they're like, oh, it's going to go back. And then it becomes too high and the thing just keeps recycling people into a grinder. Again, MB Money Visuals, Ashby, just fantastic. I've used this one before. It will never, ever, 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 ever seem like a good time to buy, ever. There will never be a moment when somebody's like, holy cow, wait a second. Politics is exactly like I wanted it to be. The world's completely peaceful. Interest rates are low. Stock market's super, super cheap. I'm crushing it in my career. The weather's super nice. And the Chicago Bears just won the Super Bowl. So now I'm going to buy. You're going to always be buying in very difficult moments. It's just always how it's going to be. So when somebody says, the market's right, I can't buy, show them this. It will just never seem like a good time to buy. And it's my favorite. It's like, I'm waiting on things to settle down. Oh, I'm waiting on a pullback. Like, I have this take of this. Is telling people to buy low, sell high, is that useless? I think it actually might be. It's a commonly used phrase, but I think it's actually useless because when the market goes lower, nobody wants to buy. So I don't know.
Yeah, and this goes back to that visual we showed of moving to cash, right? And why that scenario is not that unlikely, where you move to cash and you never get it back in the market. Because without somebody guiding you in the right direction, that opportunity often doesn't show up that everybody's waiting for.
Yeah, just before we move on, I would say I did a video on this, just like a quick take video on this, where I said, look, if you're going to get out of the market because you're afraid or something, it's your money, right? Like ultimately it's their money. But what I would beg for them is to have evidence-based triggers to get back in, which is, hey, if the market goes down 20%, I'm going to buy a little, 30%, I'm going to buy a little, 40%, I'm going to buy a little. Evidence-based, not gut-based. Like, hey, look, I'm picking this level to buy something. And then if it goes higher, you have to be able to say, I was wrong. And if it's something like, I don't know, it's above its 200-day moving average for 5 consecutive months or something, you have to have some sort of trigger that's based in not emotion to help yourself get over that decision. Because it's easy to get trapped out of it.
Yeah, I think that's great advice.
Oh, my favorite thing to end on. This is, I actually pinned this to my Twitter because I thought that this was the most pure meme or cartoon or image to share with people that either you manage their money or a friend or just soak up the lesson of the image really quickly before I address it, which is somebody with a raincoat on an umbrella looking at the TV saying that it's storming. And meanwhile, like this outside my window right here, it's just a spectacular day. And this is at the very heart of where people fail. It's the purest image of where people fail as investors. It's that they consume something from somebody that they can't quite get over. And it leads them to make a decision that, for better or for worse, ends up being a mistake. This is where people fail. I've actually said there's 2 things that you could do to improve your life tomorrow. Okay, and listen, to tell somebody that they're going to be able to improve their life tomorrow, I'm either a charlatan or I'm trying to lead them astray. I actually do have 2 things that can improve your life tomorrow, 24 hours from now. Right. Number 1 would be to walk more. Just walk more. Like I'm not even talking about like walking like a mile in like 6 minutes. Just a 20-minute walk, a 15-minute walk, whatever. It's good for your mind. It's good for your brain. It's good for your health. The physiological stress effects are just well mapped. And if you can't walk, if you 20 minutes of like stretching or some sort of exercise, some sort of movement that you can kind of get your blood pumping. And number 2 is to watch less news. Just watch less news. Like outright watch less news, because their goal is to keep you watching. What's the only way to keep you watching? To say that the world's falling apart. You know, how many times you turn on the news and they're like, 2.6 million drivers successfully parked in their driveways tonight. 2,500 airplanes successfully landed at O'Hare today. Like, you'll never hear it ever. And the US dollar, this is the perfect example of what the US dollar has gone through over the past 2 weeks. This is, everybody got their raincoats on and their umbrellas out when the dollar's literally at the same place it was back in the 70s. It's a cyclical, against other currencies, it's cyclical. It's the exact same. Pull up a DXY chart over its max. It's in the same place it was for decades. You have to, this is a good image. I would encourage people to lean into this image to remind people that being told to be afraid can be an outright disaster for their money. Being told that something's wrong, which they're being told every day that something's wrong, you know, can really be a hurdle to their success. And we as advisors, we as strategists, we at Baird are going to help them close the umbrella and go out and live their lives, knowing that the world's a crazy place. I'm not saying that it's not. I'm not saying it's not going to storm every now and then, but to help them understand that, you know, the world has always been kind of cyclical. Markets have been cyclical. Economies are cyclical. All of this is about the ups and downs, and that living a meaningful life is more important than turning on the news and being told to be afraid of something.
So, Michael, this visual is so powerful, and I would almost bet that everyone you show this visual to agrees, right?
Oh, it's a head nodder for sure. People are just like, gosh darn it, yeah. Like I you know, and you tell people, honestly, you tell a room full of people that to watch less news, and you know, wives are doing this to their husbands, and people are like shaking their heads, and like, I think people know. I think they know deep down. But it's tough, right? We're curious creatures. We're prone to being scared because of evolution, right? Like, if I hear footsteps in the distance, I'm going to be afraid. If I see a fire, I'm going to run from it. It's part of our chemical makeup. I can't discount that, but we can help people through those moments, and that's I think a core talent of an advisor, a really good advisor, is to certainly take care of the financial part, take care of the planning and the tax and the charitable giving and all that stuff. But helping this person on the screen get through this moment is a core part of the best advisors in the world.
All right. Well, thank you. You know, I think things to take away there immediately, but such a powerful message to be able to capture and deliver, and you did that so well. Do want to take a couple questions here if we can. I think we have a couple minutes. You know, if anybody does want to scan this QR code, we're trying something new here, but if you scan that, it should actually launch you into an opportunity to take a trial of YCharts and get access to some of the things that were used to create a lot of the visuals we talked through today. But a couple questions that came through, you know,
yeah.
One, Michael, the Fed is driving a lot of the sentiment, right? Maybe you call that news, something that someone should put the umbrella down and hide from. But, you know, based on the Fed still hinting at, you know, the potential of recession and how that might impact the markets, does that indicate value versus growth or any other factor tilts in your mind?
I mean, making investment decisions based on the Fed is certainly a fraught endeavor, right? They can change their mind. They can be wrong. I mean, they've been wrong before. I think more importantly is to understand that of all the things to worry about, and Caleb, we've talked about a few of them, like the Fed actually is one of them to worry about. Like, I'm not this Mr. Pollyanna that, hey, just buy and hold and everything's gonna be fine. Like the Fed really does take the punch bowl away, and then they put the punch bowl back, and they've actually taken it away, and people have suffered because of it. To try to make sector-based decisions on that stuff is so hard. Like, I find that stuff so hard because at the margin is where things change, and then there's subtle shifts that start to ripple through the system. I do think that you know, the Fed as a headwind to the market is certainly waning. We've seen inflation falling. Here's what you guys have to remember about the Fed and the stock market. Okay, there's actually two things that the stock market, it's not rate hikes that the market hates. It's actually two things: is, are they doing it faster than I thought, or are they doing it bigger than I thought? That's actually what history has proven, is that the market hates. And they did that all at 22, right? It was faster, it was bigger, it was both. But now we've reached this point where they're near the end of their game. The market's come to grips with, what does the right tail look like? What does the terminal rate look like? We've come to grips with that. And that takes that takes both of those off the table. And so to me, it's, if I'm looking at the Fed as a investment-based decision, what I'm really thinking about, Caleb, is look at what yields are now. Remember there was no yield for anybody. It was like the biggest part of the last decade.
Yeah.
Now there's yield. This Fed rate hikes that they've done have pushed yields up. And if you're a retiree, or if you're worried about your asset allocation, it's now all of a sudden that's a very, very important conversation to have with your advisor is, hey, there may be an angle on stocks, but how about all this yield? How about some of this yield? Is there a way I can capture that?
All right, one more question we'll take and we'll wrap up. So I think tied to some of the comments you made about banks and how SVB's collapse, did that really have an effect on a regional bank in Georgia? Is there something there though? When you think about investing in the finance sector, is there still some risk as depositors are moving towards the bulge bracket banks and away from some of the regionals?
It's a good question. The financial sector, banks in general, we have a really good analyst at Baird named Dave George, who's just so good in this stuff. Like it's such a black box. Like banks in and of themselves, especially the equities and what makes them move. Like they're these giant entities that kind of take in money into a box and then spit out earnings and deposit growth and all these things. Here's how Mike Antonelli, the strategist, tries to put these black boxes into perspective. And that is, does the government have a hold on the situation? Do they understand the problem? Do they understand how to fix it? Are regulators attuned to what's happening? And then, is the average person going to be affected? Everybody, to me, there's a couple things I look at. What are people's home prices? Do they have jobs? What are their wages? Are they spending money? I try to keep my macro super simple. Why, and home prices especially, because for the vast majority of Americans, the home prices, their home is most of their financial assets. It's just a chunk of their financial assets. So I'm constantly asking myself, are home prices fine? Does a collapse in SVB affect a home price in Oshkosh, Wisconsin, or LaGrange, Illinois? I don't know. Pick wherever you want. Are they affected by a Silicon Valley's collapse or Silicon Valley Bank's issue? Regulators did have a hold on it. Maybe at the margin, regional banks start lending a little bit less. Maybe credit conditions tighten. That helps the Fed. That maybe that's less rate hikes. So there's lots of moving parts here. But ultimately, I want to know will the average person be affected? Is the average worker in a small town affected by this issue? And as it evolved, I kept saying, no, I'm waiting for it. Maybe some piece of data will come out and all of a sudden banks are failing everywhere. Then the answer is yes, right? I'm trying to evolve my view as the situation evolves, but I don't want to be the kind of person, and this happens all over Twitter, where you jump to 2008. This is 08, everybody. This collapse. This is what's next. Is everything else is going to collapse? To me, that makes the least amount of sense. And I know why people do it. I get it. But to me, I'm always asking myself, is the average person affected and how? And then I laser on, is their home price affected? Is their job affected? Will their spending be affected? And I couldn't find the correlation. I still can't find it. If it happens next month, then I will change my mind. But that's how I try to view that situation, Caleb. Yeah,
I think it makes sense. I will note too, for people that know you well, they're concerned that you don't have the Patagonia vest on today.
I know. It's 80 degrees here. I would have put it on if it was 70.
we got an imposter, Michael Antonelli, for the webinar.
Yeah, we did.
But no, Michael, thank you so much for joining us. This was a lot of fun. Great insights. Really appreciate it. We've had several positive comments. I think everybody really enjoyed this.
Awesome.
So, thank you so much. Enjoy the nice weather. Have a good day, and hopefully we can have you on again soon.
Thanks, everybody.